Welcome to the Money Watch Show. It's Thursday, June 15th, and I'm your host, Jill Schlesinger, CBS News business analyst, certified financial planner. I'm joined by Mark Talercio, who is also a certified financial planner, also an executive producer, also a webmaster. What else should we add to your title, Mark?
I think that's enough.
Remember when we made up the title? I remember when Connie made up my title. And I first got to CBS. I said, what should my title be? How about senior business analyst? That's what she said. Are you watching tennis with her constantly now?
Yeah. We probably have, 20, 30 exchanges a day. She's getting ready because she got lucky and won the lottery for Wimbledon. So she's going to London. That's
cool. You've done that.
Yeah, I got lucky too. I won the lottery in 2017.
You're a lucky guy, Mark. You are a lucky guy. All right. We are here trying to help you make better financial decisions. And the way that we do that is we encourage you to contact us. All you need to do is go to our website, jillonmoney.com, click the contact us button, and you write an email. And if you want to join us on the program, you check the box that says you'll join us on the program. And if we can't quite get the schedule together and it doesn't quite work out, don't worry about it. We do email episodes from time to time. This is one of those episodes, Mark. So are you ready to rock and roll?
Let's give it a whirl.
Let's give it a whirl. By the way, when you're on the website, do all the good stuff. Buy the book, The Great Money Reset. Subscribe to our new service, Jill on Money Live. That's where you have, for $35, 12 months of quarterly access to live webinars and bonus content like awesome interviews that we are conducting all the time. So you can check it out, Jill on Money Live. Okay. This is from John, who says, I've been getting into your show recently and I appreciate the work you do. My wife and I bought a house last year. At the time of the purchase, I took a $50,000 loan out of my Thrift savings plan. Okay, I'm just going to relax about that. Interest rate on the loan is 2%, and the interest does go back to my account. That's good. So he works for the government, right? Thrift savings plan. My employer does take a minimum payment of $150 for the loan out of each paycheck. Now, if I only pay the minimums, I pay off the loan in 14 years. I contribute an additional $700 per paycheck into my Thrift savings plan every pay period. The match is 5%, $300. Here's my question. How should I prioritize paying back the loan? Assuming I have $700 per paycheck in my budget to allocate to the Thrift savings plan, should I use the $400 beyond the match to pay down the loan? If we're able, should my wife and I be heavily prioritizing paying off the loan? For example, if we had additional money beyond our typical spending, savings, and investments at the end of the month. My wife is also a federal employee. She maxes out her Thrift savings plan. We have 2 small children in daycare. That's expensive. And they're also putting $500 per kid per month into the 529 plan. Interest rate on the mortgage is 3.925%. There's no other debt, Mark. So they've got the Thrift savings plan loan and the mortgage. What do you want to do with them? What do you want to do, Mark Talercio?
I personally want to get rid of the loan. I mean, his wife is maxing out, so that's good. So that makes me feel a little bit better. If I'm him, I would still do up to the match. And then I think for the time being, I would put everything else toward the loan, I think. But also on the other hand, the interest goes back to him.
I mean, what happens is the 50 grand is out of the market. I think that's the other issue, which I think that's how these loans work, that they, so you're right. You pay the interest back, but you don't have the 50 grand that you take out is siloed off in a cash account. Are you better off paying off this 2% loan in order to free up that 50 grand, right? Because the 2% is not a big deal. We have the 529 plans. We have the amount of money that they're putting away. The real question is, what else do we need to do? How is it cash flow? They've got young kids. I don't know if I would pay this off so fast. Maybe what I would do is I would accelerate the pay down of the loan as soon as your daycare costs are freed up.
I don't know what the numbers are, but I do know that having that 50 grand out of the market for 14 years, they're going to miss out on a lot of growth.
That's not good. What we want to know is a little more information. Maybe we would do half and half. Maybe we would put it all down. But, when you're thinking about 401k or 403b or thrift savings plan loans, what you need to know is the money that you pull out is essentially that amount is cordoned off of the existing account and not invested. That is their fail safe. If you don't pull it back, they know that there's 50 grand in cash floating around. So if that's the case, then maybe we want to free that cash up as soon as possible. So follow up with some more details for us. Andrew writes, subject, am I a fool for not taking advantage of a mega backdoor Roth? So Andrew is struggling with this question. And he said he's intending to retire, quote unquote, retire by age 45 with my partner. 45? Okay, here's the issue. I feel like in order to bridge the gap between 45 and 59 and a half for us, we need to have a solid amount of taxable dollars in a brokerage account. Given that long-term capital gains rates are zero up to $80,000, $89,250, by the way, if you're married, I don't see why the mega backdoor Roth would be as desirable given its inflexibility. They've got $85,000 in taxable, tax-free accounts. Tax-free or taxable? Should they forego it? I need so much more information, Andrew. Number one, how much money do you have saved? You said you have $85,000 in tax-free accounts. So I don't know if that means that you have $85,000 in a Roth or if you have $85,000 in a taxable brokerage account. In general, here's what I want everyone to think about. You don't have to maximize every dollar. If part of your plan is that you need to access money before age 59 and a half, you do need money that's in a brokerage account. That's where your access point is. And if you are thinking about age 45 as retirement, quote unquote, what else is happening? Are you making money? Do you have to pull any of this money out? Do you have to live on this money? Or are you going to just do something else? Also, just remember, you said you had a partner. The long-term capital gains rate of 0%, you have to be married, no partnership. So you got to be married, and it's up to $89,250. If you are single, the long-term capital gains rate stays at 0%, up to $44,625. Okay, now this email is from Matt, who says, hey, Jill and Mark, my wife and I listen to you daily, and we always appreciate your honest and insightful advice. I know from listening to enough of your episodes that you're not fans of life insurance policies as an investment vehicle. However, it feels like I can't go anywhere without getting pitched to use whole life insurance as a popular form of investing. Social media, conversations with our friend group, and then he sends us a link from Instagram. When this came up in conversations recently, I felt equipped to say that the fees and commitment made me feel wary of life insurance as an investment vehicle, but didn't have more arguments at hand to defend that viewpoint. Can you discuss in greater details the scenarios where life insurance as an investment vehicle makes sense, where it doesn't, and why? This is a great question. So thank you, Matt and Katie. Here's where it makes sense. Let's say you need life insurance for your whole life. Maybe it's funding a trust. Maybe it is funding a long-term gift to a charity. Maybe you need permanent life insurance because it's funding a buy-sell agreement for a small business or a medium-sized business. The use cases for whole life start with the people who need life insurance in place for their whole lives. And it doesn't have to be, we're going to say, let's use whole life as kind of like a code. The code is permanent life, really, meaning it's whole life, it's universal life, it's variable universal life. So these are the kinds of policies that build up cash values. And they defer taxation out into the future. You don't have to actually pay for any of the tax that accumulates in the policy. If you withdraw the money, there could be taxes down the line. But, if you build it up and you die, then the proceeds flow into the trust or to fund the buy-sell agreement. And there is not a tax event with insurance proceeds in that case. Okay. The thing is, I don't think that that's what you're being pitched. It sounds to me like what you're being pitched is the idea that insurance companies say is, it goes something like this. You know what? If you invest in life insurance with an investment or cash value component, then you can accumulate wealth. It's shielded from taxation. If you want to access it later in your life, you can borrow the money out. But if you pull the money out, just to be clear, I'm just as like me, Jill talking. If you actually withdraw the money, there is a tax event. There is actually a tax event when you pull the money out. So you'd have to borrow the money out. And maybe the best use case in that scenario is somebody who wants to have some sort of life insurance slash hybrid policy with some long-term care options. Now, this type of policy usually comes with a lot of fees. The fees are such that I think that people really blind themselves to them. They don't realize that it could be triple the amount you would pay for just a portfolio of mutual funds. And the idea of losing access to your money because you now have a liquid asset that's been converted to an illiquid asset, an insurance policy, is huge. If everybody is being pitched this, it's usually because the insurance company's gone great guns and really wants to tap into last year's bad market, kind of say to people, well, we can give you this with a guarantee because there are certain parts of the policies that can be guaranteed. And it sounds great. But it's not unlike, I just had this conversation with my friend Michael because I had another friend who was being pitched an immediate annuity. And with an immediate annuity, which is unlike a variable annuity because it doesn't have as many fees, but they say, the insurance company says, give us a chunk of money. We'll use current interest rates and your life expectancy, and we'll churn out a certain amount of money every month. And it sounded great. And then I finally kind of was digging into the policy over the weekend. And long story short is that I found out that lo and behold, Mark, it's $1,700 a month. Sounds great, but there's no inflation that is factored in. So the $1,700 a month you receive now that seems to solve your cash flow needs is worth about half of that in 10 years just because of inflation, not high inflation, regular old inflation. So Mark, did I miss anything from the explanation there?
I don't think you missed anything. What I will say, this email is a clear example of be very, very, very careful where you get your advice. I mean, Jill, on your end, you should really open this Instagram link and see how fast your head starts spinning.
Okay, I'm opening it. Hold on a second. Oh, okay, I see. All right, so who is this dude who is giving the advice? Wow. Wealth protector, entrepreneur. So it's an insurance company, all right? And he doesn't even have any licenses. That's unbelievable. It is such a great message because here I am going through a long, lengthy thing. And what we really are getting to is you have to be very careful how you filter messages that are coming in from Instagram or from anything else that's like any social media, Twitter, that people who are basically professing to be experts, this guy's not even licensed. People are just like, oh, that sounds good. And they just do it. It's terrible. Matt, you are, what you really need to know is that every single product pitch that you receive is what you should actually come to us and say, okay, how does this actually relate to me? I'm so glad he got in touch with us, though. That's great. All right, Mark, I think we got to call it a day. What do you say?
Rapperoo.
Rapperoo. All right. If you want more information, if you are being bombarded with marketing messaging and you want to know, is that for me? Just go to us, JillOnMoney.com, click the contact us button, send us what you've received, and we'll be happy to walk you through it. It's very easy for us to do this and kind of pull it back. I think it's like pulling back the onion, right? That, we're pulling back, we're telling you what these products really are, what they're not, what they can do, but also like who's offering this advice, who's proffering this advice. That's really important to us as well. JillOnMoney.com, contact us, send us whatever pitch you're getting. And don't forget to sign up for the free weekly newsletter, and you can buy my book, The Great Money Reset, right there on our old website. Mark Talercio is the co-host and executive producer. Karen Kranick is our web queen, and we are distributed by Paramount Global. We drop our episodes every Tuesday and Thursday. Put your hands metaphorically on someone's back. Change your work, change your wealth, change your life. Thank you for listening. We'll talk to you next week.